Let's kickstart the first conversation of the day, and that has to do with arbitrage funds as well as liquid funds and other ultra short funds in the fixed income space. Joining me to talk about this is Amol Joshi of PlanRupee Investment Advisors. Thank you so much, Amol, as always, for taking the time, and good evening to you. Let me start by asking you about arbitrage funds, because I don't think that a lot of people know about this. What are they? How do they work?
The show. So yes, Alex, it's a right question. It's a right way to approach. Not many people know about arbitrage funds. The simple reason is arbitrage funds are categorized as equity funds, and typically from equity, your expectation in general is that these are the funds that are meant for wealth creation. In the sense, you will invest in these funds, probably try to stay put over a longer period of times. It comes with kind of risk that equity carries, and then you'll probably able to generate inflation beating, traditional fixed income instrument beating, double digit kind of returns, let's say 10, 12, 14%, that kind of a thing. However, arbitrage funds are only categorized as equity funds. They are not your out and out true blue equity funds. Now, what do I mean by that? Arbitrage funds, as per SEBI's scheme categorization of 2017, these funds essentially have to invest 65% or more into equity related instruments. Remaining 35% can be into debt or other fixed income assets. But this 65% equity exposure essentially has to be a non-directional equity exposure. What do I mean by that? Arbitrage, pure simple meaning of the word also. In the most traditional sense, arbitrage used to mean a stock is trading at, suppose, 140 rupees in one index, in one stock exchange, and the same stock is trading at 142 or 144 rupees in another stock exchange. You buy in one stock exchange, sell in another, and thereby making the difference. That's the traditional meaning of the word arbitrage itself. However, as the markets have become efficient, everything is on a click of a button, and there are very less such arbitrage opportunities. However, there is certainly one arbitrage opportunity, that is where these arbitrage funds invest. And that arbitrage opportunity is buying a security, suppose, in a cash market, and selling the same security in a futures market. Typically, stock futures is what I'm talking about. So thereby, these funds take a non-directional exposure to equity. Now, this sounds slightly technical. What is non-directional? Non-directional doesn't mean anything. It simply means that even if the market goes up or market goes down, the fund still makes the arbitrage, or more commonly these days known as the spread between buying the security in cash market and selling it in a future market. So that's very quickly what arbitrage fund does for you. It is an equity fund. It gives you equity taxation, which is supposed to be better because long-term capital gain tax kick in within 1 year itself. In debt mutual funds, long-term capital gain tax kicks in only after 3 years. So these are some of the points that are not very well known to typical investors.
Okay, so I think you've explained it quite well. But just to drive home the point, Amol, you would look at these, and you mentioned that these are not equity investments in the traditional sense, because they're playing an arbitrage. And arbitrage, I'm sure that a lot of my viewers know this, arbitrage has existed as long as marketplaces have existed, which is a very, very long time. And it's essentially a game in which there isn't a significant amount of risk involved in terms of how much you can lose. Capital loss is not something that you worry about. Could you drive home this point, Amol? When you invest in this product, you're not looking at outsized gains, right? You're looking at steady returns, and you're looking at investing in an equity product. Is that correct?
Correct. And that's why within my first answer, or within the first opening itself, I mentioned that although it is categorized as an equity fund, it is categorized as an equity fund because it invests into equity assets. Otherwise, it is not your traditional equity fund the way we know equity funds as, let's say, large cap, let's say multi-cap or a flexi cap fund. These funds invest 100%. In the sense, these funds invest large chunk, 80 to 100% of their assets into pure equity and a directional exposure. That's what those funds are. But arbitrage funds certainly do not do that. You also touched upon the point of outsized returns. So let's quickly talk about returns. We spoke briefly about if you stay invested for a 3-year, 5-year, 7-year, a long enough period into equities, you'll probably generate inflation beating returns or inflation plus risk premium kind of, fixed in risk-free rate of return plus equity premium, that kind of. So let's say 12% kind of return. However, since arbitrage funds are not taking any directional exposure and the only, the objective of arbitrage fund is to get you safe and equivalent of traditional fixed income product like a liquid fund, that kind of return. And hence, let's talk about returns as well. Last 1 year return of most of the arbitrage funds has been about 3.5% or so. Let's call it 3.5 to 4%, 3.5 to 4%. So you will realize, you quickly will pick up that this is nothing but the rate of return, 1 year return, past returns of course. Past return is very, very similar to liquid fund. And this exactly plays out if you look at a 3-year return, point-to-point return, or even a 5-year point-to-point return. For 3-year, arbitrage funds have generated about 4.5% return over a 3-year CAGR, and liquid funds have generated a similar kind of 4.5 to 5% kind of return. So the real crux of the matter is whether you fall into the highest tax bracket and you have preferably 3-year kind of an investment horizon. If that is the case, then instead of investing into a liquid fund and paying short-term capital gain tax, which basically, if short-term capital gain tax is something that you have earned out of your mutual fund investments, the income will get added, the capital gains will get added to your income, and those will be taxed at your marginal tax slab. So if you have somebody in a 30% or higher tax bracket, from a 3% sort of a return, you actually take home only 2%. 1/3 is lost to the taxes. If you take the same 3%, which is an hypothetical number, if you make the same 3% return in arbitrage, the tax incidence is only 15%, 1/5, compared to liquid 30%, and thereby your take home is higher. So you're right when you say that arbitrage is not to make outsized equity fund, equity kind of returns CAGR. This is essentially a short-term cash parking, temporary 3 to 6 month, 6 to 9 month kind of an exposure product, which is more comparable to liquid fund from the returns perspective and not really the equity funds.
Okay, I know you've already spoken about the tax aspect. We'll refer to it again, but first I want you to talk about the short duration funds in the fixed income space. Because there are several to consider, right? There's the ultra short, there is also the overnight, there is liquid. How does one decide which one to invest in, and would you be able to describe what these funds are meant to achieve?
Right. So see, Alex, what I believe most of the times the name gives out a message. Name talks a lot. So you mentioned three categories. Let's talk about those 3 categories. There are many more, but let's start with something that starts at the lowest investment horizon. Okay. So overnight funds. Overnight, the word itself gives you an idea that this is something to do with a matter of 1 day, 2 day kind of a thing. So overnight actually means you will hold that paper. You have asset, mutual fund. Overnight mutual fund holds an asset which matures the next day. Okay. So if you have amount to invest for starting with 1 day, as low as 1 day, but more on a practical basis, you have money to invest for a week, for 10 days, for 15 days. Overnight fund is something that you would consider as an investor. Coming to after overnight, something comes as liquid fund. Now again, the word itself gives out the meaning that this is an investment which is very, very liquid. So you would not want to invest over here and sit for 3 years, or there would be a 1 year lock-in, or there would be exit load. Liquid funds earlier did not have an exit load. However, a few years back, there is a 7-day kind of liquid exit load, which is very, very minimal. 0.005% is the kind of load that liquid funds have for 7 days. But this is what distinguishes liquid funds from the overnight funds. So for liquid funds, typically I would suggest to invest if you have between 15 days, between 2 weeks to let's say 4 week, 8 week kind of an investment horizon. And then there are multiple categories. Ultra short is another. So after overnight fund comes the liquid fund. After liquid funds, you will have something called as an ultra short. So ultra short, my recommendation is if you have a 3 years or more kind of an investment horizon, then you would invest into ultra short funds. And then there are many more. There is short term fund, there is low duration fund, there is medium duration fund, so on and so forth. But since I mentioned liquid fund as a comparison or as a comparable product with arbitrage fund, let me spend a minute on liquid funds. These funds, like overnight fund, invest into securities that mature only in one day, that is next day. Liquid funds typically have to invest into securities that mature as short as 60 days to 91 days, right? So they have to maintain this overall maturity within the fund to be compliant with the SEBI regulations. And that's what makes these products, even in the debt asset class, very, very less volatile. Now, what do I mean by that? If you invest in a 10-year gilt fund and if the interest rates make upward or downward move, you have significant mark-to-market gains or losses, although of the temporary nature, accruing to the gilt fund. Liquid funds are immune because they invest into papers maturing 30, 60 or as less as 60 to 90 days. So that's how you look at various types, especially based on the maturity of those papers, various types of short-term debt instruments.
Fantastic. And the other very simple way to look at it is, and what you described essentially is duration risk, right? Where if you have a significant move in the interest rate on the upside, then you have the potential for loss of capital. The longer the duration, the higher the duration risk. So therefore, if you're holding shorter term papers through the liquid fund, of course, Amol, you don't have that kind of a risk. But to the point that you were making, and I wanted to ask you this question at the end of the conversation so that we could drive home this point. But let me couch it in a different way. You have a scenario where you have to choose between arbitrage and liquid funds. What are the purposes that you would use this for? Essentially, you would be looking at creating a corpus for an emergency or something that you need access to very quickly. And we are going to talk about emergency funds in the next part of this show. But how would you choose between either arbitrage or liquid? And within that fixed income space, you would obviously go for liquid, right?
Yeah, within fixed income space, obviously I would go for liquid funds. So that's very simple, way to answer it. There is another class of investors, as I mentioned. If you are in a higher tax bracket or even the super rich tax bracket, which goes as high as 42, 30, after 30, 35, 38, 42, those kind of percentages. And if you have a 3-month kind of an investment horizon, then arbitrage funds also make sense for you. And I reiterate that this is especially for people in the highest tax bracket. But coming to the previous part of your question, which I find very, very interesting, what will you use it for? For what purpose will you deploy money into these short-term instruments, be it an arbitrage fund or a liquid fund? Very interesting question. And there are 2-3 scenarios that I have seen throughout my career of managing money for people. What I have seen most of the times, typically you can have money coming to you as an annual bonus. Suppose you get that bonus in the month of April, May, let's say something like this time period, and you have a plan of holidays coming up, let's say in December. So you have hardly this 6-month kind of a window where you will not be very, very comfortable investing into an equity product. Neither any one of us will recommend that. At the same time, you want to earn something higher than the saving account return, which will probably currently fetches you around 2-2.5% in most banks. That is the time when you'll invest in probably liquid funds or ultra short-term funds if the horizon is between 3 to 6 months, or into arbitrage funds. So that is one point that many times I have seen people putting the money that they existingly have with them for a 3-month, 6-month kind of goal, which is a holiday or a vacation, annual trip kind of a thing. Another way that people use it for is planning for the school fees or tuition fees, which again, you typically have to pay that in the month of May or June. So you put money into liquid funds, 10, 20,000 rupees a month, and over a 6 month, you accumulate the desired number over there into your tuition fees corpus fund. And another point, as you mentioned, and I would like to listen into that conversation as well, emergency fund, you do not know when the emergency will strike. That's the definition of it. And that's why you do not want to have those funds locked in. You do not want to invest those funds into volatile instruments where you will see your 100 rupee becoming 92. That's not something that you're looking forward to. And you will invest probably into shorter duration, something like a liquid fund or an ultra short-term fund, or a non-directional equity exposure fund like an arbitrage fund. So these are some of the uses that you can use these schemes and funds to deploy funds for anywhere between a month or 3 month to 6 month kind of a duration. Emergency fund obviously will stay over there for longer. We all hope and pray that no emergency strikes any one of us. However, those funds will sit there longer simply because they are for an identified purpose with no defined date.
Absolutely. Thank you so much for spelling all of that out. As always, pleasure speaking with you, Amol, and look forward to the next one already.
Sure. Thanks, Alex, for having me on the show.